This is really about being free to create what you want your life to look like. We each are our own hero. And how do we take the challenges that come our way and see those as the birth process of us becoming heroic? Can you meet that judgment that ultimately will surface with neutrality?
This is the Wall Street Coach Podcast with Kim Ann Curtin.
Welcome back, everybody, to the Wall Street Coach Podcast with me and Lucas Peterson. I'm very excited today because Jack Schwager is with us. I am so excited to have an opportunity to let you hear his incredible wisdom. A little bit about Jack. If you don't know who he is and you're a trader, then I want to know what rock you've been living under, because most traders actually know Jack Schwager as the most recognizable name, most of all because of his tremendous book called Market Wizards. And that was the first of many books that I read of Jack. He has so many books, and I'll mention them all, but the other book I really want to strongly recommend out of the gate to traders is Market Sense and Nonsense. I think that one also is tremendous, Jack. And your most recent book, The New Market Wizards. But a little bit about Jack first. He is a recognized industry expert in futures and hedge funds, and the author, of course, of all of these books and many more. He is one of the founders of FundSeeder, a platform designed to find undiscovered trading talent worldwide and connect unknown successful traders with sources of investment capital. Previously, Jack was a partner in Fruition Group, a London-based hedge fund advisory firm, and his prior experience also includes 22 years as the director of futures research for some of Wall Street's leading firms, most recently Prudential Securities. Welcome, Jack, to my podcast. It's so good to have you here.
Thanks, Ken. Nice to speak to you again. Just one correction. The most recent book was Unknown Market Wizards.
Oh, it was Unknown Market Wizards. Yeah. My mistake.
New Market Wizards was the second of the Wizard books.
That's right. It was. I'm so sorry I mixed those up, but I've read them all.
Yeah.
But I really loved Unknown Market Wizards because I felt it really spoke. It just felt very timely. Tell us what prompted you to even write that.
Well, a couple of things. One is a relation is FundSeeder idea, which I'm involved with, which is basically a platform for traders, and our goal is when I say platform, it's a platform that traders can use to analyze their performance and get various graphs, even do technical analysis on their equity curve and stuff like that, and all sorts of performance stats. Our goal is not to monetize that. That's really just a lure to get traders on the platform. And our premise was that there's lots of traders out there that are really superior, to most traders, but nobody knows who they are. Nobody knows where they are. They're just in their office trading and doing well, So our goal is to find these traders, and the monetization comes from a sister company, which is FundSeeder Investments, which is now just getting started in operation. I mean, it's been around structurally, but the idea was to first get a database of traders. And FundSeeder Investments would use the database of the FundSeeder technology, which is a trader platform, as a source to create investor product. And while we didn't necessarily know what the first direction was going to be, whether it was going to be linking traders with institutional investors or whatever, the way we're going now is our first product will be a multi-trader fund, and other things may come beyond that too. So because that focus of looking for kind of really good traders who nobody knows, that sort of naturally led to this idea of unknown market wizards. Plus the last market wizard book I did, which was Hedge Fund Market Wizards.
Right.
That book was done, it was about 2012, actually just before I did the Market Sense and Nonsense. And in that particular case, the focus, like the title says, was just on hedge funds. So this was about as far away you can get from that concept. Instead of looking at managers with large operations, I was looking for kind of the solo trader, So it's a combination of those things.
Yeah, that makes a lot of sense. Now that you have this database, are there commonalities that you do see among all of these unknown traders?
Well, there are lots of commonalities. Not all of them apply certainly to all traders. The one commonality that applies to almost all traders is not going to be a surprise, is risk management. So I think as you go through the chapters, this book as well in almost every chapter, every Market Wizard book, you will see that the risk management theme comes up very strongly. And I think one thing that separates really professional traders or successful traders from those who are not is an understanding that first and foremost, trading is about not losing too much and staying in a game. And or just the other phrases really for what risk management is supposed to do. And then secondarily about the approach you're using. Now you need both. You can't succeed without some sort of edge and methodology, but there's an understanding that if you don't have a solid risk management plan, even with a good methodology, you're vulnerable to blowing up at some point and being knocked out of the game. You can't bet if you lose your chips and that type of thing. So that's one major commonality. I think, particularly in this book, but it comes up again and again. But you'll see these traders have tremendous self-discipline in many ways. Both the intensity of self-focus, the amount of research they do, the amount of analysis they do in their own trading, the discipline comes in, of course, in the risk management side too. So a couple of these traders are trading very, very large on high confidence trades, and the only way they can get away with that without blowing up is they really have super strong risk management, and indeed will get out immediately if it's not the market isn't reacting exactly as they expect. If they hesitate, and there's an example in the book where one of these traders who trades this way sort of put on a trade and it went really suddenly against him and he froze and he was thinking, I can't get out, I can't take this now. And he waited a little bit and the market bounced back and he ended up with not that much of a loss. But this episode came up in answering the question, what was the worst mistake you ever made? Because even though the decision to wait in that case turned out to be helpful and turned a large loss into a small loss, he recognized, and by the way, after it bounced back and he got out, it didn't bounce back all the way, then it completely cratered. And had he not gotten out at that little bounce, yes, he would have really taken a devastating loss. So he recognized that he was just super lucky.
Yeah.
And that initial freezing and not being able to take that initial loss was a huge mistake, and sort of swore to himself that would never happen. And that was like the one episode where he had that lapse of discipline. But you have to, it's almost 100% thing if you're trading that way. You can't mess up one time. You always have to be totally rigid. One of the traders in the book is, I used to say ex-Marine. I was corrected by someone that said there's no such thing as an ex-Marine. But anyway, so his Marine background, I think, was, well, he attributes it not only to success in trading, but in saving him from kind of being a failure in life in general, to turning it all around. Wow. And but I think the discipline he got through the Marines sort of is instrumental also in his trading.
Yeah. What is that's just such great story, that particular story. I have no doubt every trader listening to us will feel their, stomach turned with that story, and they can imagine it because it's already probably happened to them. Hopefully not with as much of a devastating loss, but that's probably the case for some. What do you think is the biggest misnomer for, let's say, the traders who might be successful after this past year and a half, 2 years, but what perhaps might they not have seen or experienced yet that you would like to say, keep an eye out for this?
Well, first of all, in general, particularly for newer traders without a lot of experience, say trading only a year or a couple of years or whatever, and we've had a market environment, well, certainly since the bottom in March last year, for the last year and a half, where the market is just kind of, well, recently it's gone a little more sideways, but we basically had a unidirectional market, and very easy for traders to, and buying the dip has always been the right thing and stuff like that. So one thing in general, not just in this environment, but let me take the bigger picture first, is I think traders need to be careful about getting complacent and thinking they got it, because my personal experience, and I think a lot of traders I interviewed is when you think now you got it, that's when the market will always surprise you, and things are always changing, and the market changing is a theme that comes up, quite a bit in this book, I would say. So one thing is, just in general, beware of getting that feeling that, oh, I got it, I got it nailed, because the market will, it's just a matter of when, but it will surprise you. And my experience, and I think the experience of a lot of traders, is your worst periods come after your best performance. There's a couple of reasons for that, but we can go into that on a tangent at some point if you want. Now, particularly in the last year and a half, the danger is if traders have come in just during that period, they've experienced one type of market and sort of maybe totally unprepared, and the market changes. And then there's the other thing, sort of like, which has become a thing, so to speak, in this last year, and it's kind of a new thing, is this Reddit trading, right?
Yeah.
Where it's kind of like enough of a replay of the greater fool theory, sort of people are recommending you buy, and your hope is that you'll sell it to somebody else who comes in even higher. I mean, that's ultimately what you're doing. But buying stocks really for no other reason than as a group buying it, and you're going to stick it to the man or whatever. And I think that's just that's kind of a losing mentality. I mean, it's a mentality that can't work in a long run. And my feeling from the very beginning was, hey, yeah, some of these people make money, particularly the ones who are early, and so the ones, you take a stock like GME, where you have people early kind of analyzing the shorts are maybe vulnerable to a squeeze, and sort of they take a position, and then they convince enough people, sure, they're going to end up okay. They're probably getting out, on the rally. But then these people come in and buying the stock at, 400 or something like that. I mean, those are the people who, end up holding the bag. So I think some of those things that are current, and that only recent traders are particularly experiencing or using, are not things that are going to turn out well, I think, for the majority of those participants.
Yeah. The traders that are sophisticated, that have been in the game, let's say at least, I want to say 7 years or 10 years, do you think it's required for them to go that length of time, that they have to be at their desk every day, 5 days a week? Or do you see that the ones who can go for a really long time manage it in another way, just around being in front of your computer screen all the time?
Well, first of all, almost nobody is going to be good all the time. Every trader's going to have periods where they're just not doing well, or their methodology is a little bit out of sync, and they talk about that, and the solution is typically just to stop trading, for some, could be just for the day, could be just a matter of, okay, this is just not working, it's a bad day, I'm closing out everything, I'll come back tomorrow, or maybe I'll come back next week, whatever. I mean, that depends on the trade, depends on the methodology. So nobody's going to be good all the time, obviously. But the 10-year thing, and I mentioned, I don't know if I mentioned it explicitly in the book, or maybe I did, maybe I didn't, I don't remember, but I certainly, it's something I do when I'm looking for people to include in a market wizard book. Typically, I'm looking for at least a decade-long performance, preferably longer. I mean, some of the people in this book have a couple of decades or of trading experience or more. And the reason for that is, one exception is one trader who maybe had like an 8-year record only at the time I did the interview, but I made an exception because that 8-year was like exceptional, and I kind of thought he would continue to do well. And so I mean, a 10 year is not rigid. It's ideally I'm looking for at least that. So it's really a matter of just kind of saying, okay, at least it's not a flash in the pan. And if you're going to take somebody who has a good 2-year record, I mean, it doesn't prove anything. They might just have been on the right side of the market for 2 years. And, if it's a bull market and they're long, a rising tide lifts all boats. Doesn't mean they're a genius. It might just mean they took more leverage and more risk in a up market. It doesn't prove anything. So I'd like to see a certain minimum time to suggest that, hey, this person really has some edge, is superior, is really top, sort of upper echelon, not just lucky. And that's one part. The other part is a performance that is really exceptional, and exceptional could fall into two categories. One is someone who just compounds a relatively small amount of money into a really substantial account. I mean, it could be like the most extreme cases. The most extreme case in the book is a fellow by the name of Jeff Newman, who started with a sub $5,000 account like about 15 years before I did the interview. And when I interviewed him, he had kind of cumulatively made about $50 million out of that 5,000. And I haven't spoken to him for at least about 3-4 months or whatever. But the last time I spoke to him, he had quadrupled that. So so that type of thing is extraordinary. I mean, there's another trader, Chris Camillo, started with 80,000, and it's over 20 million. So I mean, so that type of thing. And then you have traders who just have this extraordinary. They may not compound because they're pulling money out of their accounts. I mean, they're trading in a way which doesn't necessarily lend itself to just compounding, but they may want to just keep trading $1 million, $2 million, whatever it is, and pulling money out and investing it in real estate or whatever they do with it. But their return risk is just extraordinary. Sort of like I don't use the Sharpe ratio, and the Sharpe ratio is not a good measure because for the type of traders I look for, because their returns are very asymmetric. So their gains are much larger than their losses, and the Sharpe ratio penalizes upside volatility. But in return risk terms, they've got numbers that are like 10 times or 15 times the level of what would be considered a good return risk. Wow. Sort of like a Sortino ratio. They'll have Sortino ratios that are just, like I say, 10 times as high as what would be considered a really good Sortino ratio.
Wow. It's amazing. Amazing. Did you go to say something, Lucas?
I just have a question on, you get to talk to the best of the best of traders, right? And I wonder, in your opinion, do you think anyone, like the turtle traders kind of proved this, but do you think that anyone can be a good trader on their own without a lot of maybe guidance along the way?
Yeah, well, first of all, let's take the second part of that question first, the guidance. Ultimately, traders have to figure it out on their own. They have to come up with their own methodology. I don't remember interviewing anybody who learned a methodology from somebody and then continued it on their own, and that's what made them super successful. Now, they may have learned things from other traders, but they still ended up with their own methodology. So I think the idea that you have to find somebody to teach you the way to trade is a misconception. You can learn good things. You can learn good traits and certain ideas from traders who are successful, but ultimately you can only pull out those things that will work for you. So it still has to be compatible to your own approach, and you ultimately do have to develop your own approach. As far as can anybody be a successful trader, I think that kind of being net successful or net profitable is an achievable goal, probably for most people, but ultimately, having sort of extraordinary performance, that I think sort of is a combination of doing all the right things, but I think there's some innate skill there. And it's sort of like anybody can learn. I guess anybody. I don't play the violin, but I assume if you practice enough, anybody can learn to play the violin. But the amount of people who have sufficient innate talent to be the lead soloist with a philharmonic orchestra, you're dealing with a very small number of people. And I think it's the same in any profession. It's only going to be a certain small percentage that can excel by definition. Not everybody can be exceptional.
Yes.
It's an average for a reason, right? That half the people are below average, half the people are above average. Now those traders who do everything right can be in the above average section, but not everybody's going to be exceptional.
Yeah. Yeah, it's such a great point. And I'm almost curious, when you have traders who approach you, new and sophisticated ones, they're probably at times, I imagine, asking you, should I stay in the game? Should I try to see if I am the one who's exceptional? What's your advice to them? Like, what's the litmus test?
Well, I couldn't answer a question like that because it's so dependent on the individual.
Yeah,
and what their approach is and everything else. So I that's the type of question that I couldn't answer. I suppose, and I don't do. This is kind of your area where you do coaching and stuff like that. But I don't do that unless you consider my books coaching and stuff like that. But but I don't physically sit down with traders and analyze what they're doing and figure out what they're doing wrong and that type of thing. But the question like the one you asked really requires really knowing the trader, what they're doing, their psychology, a lot of things. So it's really trader dependent. There's no general answer that you could have for that type of question.
Yeah. I'm curious if traders are still finding FundSeeder. Are you seeing any increase in women coming into trading?
John, I haven't looked at it. I know that if I look, when I look at like the top, 40, 50 trade, usually, it's very heavily male dominated, and I just think it's kind of that's not that there aren't women traders out there, not that there aren't successful women traders out there, but it's very lopsided in terms of participants. So, Personally, I think that if you had the same amount of women drawn into trading as men, you'd probably have more than 50% women because, my feeling is they have two advantages, I think, which are gender-based. Is one, I think they're probably more, they're less this idea of ego and being right and being rigid and all that. I think is more of probably a male trait than it would be a female trait, and that's a negative trait for trading. And I think maybe I don't have the data for this, but I would suspect women are probably more intuitive than men are. I don't know. If I had to bet, one could do an experiment. I had to bet. I'd bet the women were more intuitive, and being more intuitive is kind of good in trading. So I think that there's no reason why women shouldn't be as good or better than men. It's just a matter that, hey, if you have 100 males going to do trading as an endeavor, for every woman, it's going to be lopsided just because your populations are very, very different.
Yes. I'm glad you spoke to that. And I also want to say a couple of things here. First off, I I remember asking you, because when I was interviewing people for my book, trying to find more women was really a struggle. And when I first met you to interview you, you expressed the same frustration. You wanted to feature women and just, weren't able to find those track records of longevity or a big enough pool. And I was so impressed that was something you had even noticed. So I think, just to hear you speak to that today, I just, guys, if any women are listening to us, please go find out if this is for you. It may not be, but gosh, what if it is? I do think there is a bit of an edge that women would have.
Yeah. And I'd love to see, there's been nobody, I'm not aware of any studies that have been done on women traders versus men traders, but it's hard to find. I mean, the data, it's hard to identify. It's hard to find women traders. And
yeah, for sure. I have a colleague who's actually running a fund where she really wants to have women traders. And, she's been searching high and low. I've given her some women's names, but she really wants women with a track record. And she's just shocked at how hard it is to find.
Yeah. I mean, there are a few women who do come up well in FundSeeder, but the ratio is just very lopsided. So as we're speaking, I can think of two women I can think of that been doing quite well and that show up, that are in FundSeeder that I'm aware of, but it's really lopsided, ratio of men to women.
For sure. Let's talk a little bit about market sense and nonsense, just because I thought it was such, one of the things I love about your writing, Jack, is you are always speaking in terms, you don't use a lot of, as they call them, $3 words. You write in such a way that I think even people not in the finance world could understand what it's this I think it's a very hard thing to do, to be a storyteller in a nonfiction setting. And you do that really, really well.
Yeah,
and
I appreciate it, because that's one of my major goals when in writing.
It's so, I think it's really hard to write in a way that's storytelling, or write simply. It's not as easy as everybody thinks. I think it's easy to use these big words and complicated descriptions, but if you want people to understand what you're writing, yours just made me, at the beginning when I first read Market Wizards, I was probably on the fence about whether to write my book or not. And when I finished Market Wizards, it gave me a boost of confidence, because you had written it in a way that I knew, wow, people outside of finance are going to understand this book. Maybe I could take this leap and try to write my own. And a quick shout out to how gracious you are. When I reached out to you, I was a nervous wreck to reach out to you, by the way. You were like one of the first people I interviewed, and that's 8-9 years ago.
Yeah.
Because I thought you would say to me, who the hell are you? And are you trying to copy my idea? But I was like, your idea of reaching out to multiple people, let me ask you that first. What brought the idea for Market Wizards from the start to fruition?
I just, I was, I guess, in the business about 10 years or so. And I don't remember where the idea first came from, but I just thought it'd be a neat thing to, a neat idea would be to go write a book where I go around and interview, the kind of best traders in the country. And both would be fun to do. And, I was kind of trading as a hobby, as a sideline. I had a job as a research director, but I sort of be a way to self-improve as well, so and a combination of it'd be an excuse to pick their brains, and it'd be a fun project. And so I just had the idea of Market Wizards, and I had it for at least, several years before I actually wrote the book, because I was working at a full-time, more than full. Being a research director is kind of more than an 8-hour day by itself. But I had written that first book, A Complete Guide to the Futures Market, which was totally different, which I took a sabbatical on. And it's an analytical book. It's almost 800 pages long. It was, immense amount of work. And it was not aimed at a broad audience. We're trading futures and wanted to learn different analytical techniques and stuff like that. So and I just was writing that because I thought I could do a better book than anything that was out there. So that was my goal and nothing more. But then I had the idea for Market Wizards, and it was just the catalyst being some publisher approaching me to do more analytical books, basically at a lunch, and I kind of said I have no interest in that, but this is an idea I had, and they said, "Oh, good, do that." And so that was a catalyst, and since I wanted to do it, but I was kind of scared off because of the time commitment. But that's how it came about.
Yeah, it's awesome.
And it essentially ended up being a nights and weekends type of project.
Yeah. Yeah. And was there surprises along the way as you began to interview? Name a few of the basic, just you can name them all, but just say some names for those who are sadly not read that book yet.
Yeah, a lot of people, first Market Wizards book, and I kind of sort of trading legends, I guess, Michael Steinhardt, Bruce Covener, trying to remember, it was between the first two books came in a couple of years, Stanley Druckermiller, Richard Dennis, I don't know, but there were a lot of people, Paul Tudor Jones.
Yep. Jim Rogers.
So, a lot of people who were kind of famous as being sort of the best, among the best of traders of recent modern times.
Yeah. Yeah. What was the most surprising thing at that journey as you started to do those interviews? What do you think surprised you in the journey of that book?
Well, the most surprising thing was quite a few of these traders, as successful as they ultimately became, went through early experiences where they were who either suffered really enough losses that kind of knocked them out of the game, at least temporarily, or came very close to being just being knocked out of the game. I think of somebody like Paul Tudor Jones. Early in his career, he was basically on a cotton floor, and that's was a specialty. And there's a story in the original Market Wizards book. I won't go through the whole thing, but essentially, he had one trade where, and I can give you the story if you want.
Sure.
Okay. So the basic story is, and I have to kind of give you a little context here because
sure,
I used to be a cotton analyst, so I kind of know that market.
Yeah.
And so when he told the story, I kind of understood it well.
Sure.
But cotton, for those people who, for 99% of the people who are not familiar with cotton, there's an old crop and a new crop, and old crop deliveries can only be made on the last month of July until you go to a new crop. So July can be kind of tricky in terms of deliverable supplies and stuff like that. And so this was a situation where the market was had been gone down and went into this sideways market for a number of months. And one day, and Paul's down on the cotton exchange floor, back in the old days when we had pits and we didn't have electronic trading, really kind of ancient days. And the market goes to a new low, goes to a new low, and then suddenly rallies back into the range. And Paul looks at it and thinks, bear trap. Now, this bear trap is sort of an idea that still is relevant today, and that is and not just the cotton, to any market. It's the opposite, is the analogy on the upside is a bull trap. But on the downside, basically what it means is you'll see a lot of times you'll get reversals. The market will make new lows and then rally back. And what's happening is the new lows will wipe out. People tend to put their stops at new lows. And sometimes there's a very large accumulation of stops at new lows. So the markets will be drawn to that for a number of reasons. We'll wipe it out, leave a vacuum, basically clear out the selling. And then there's a vacuum up and it goes. And not all the time, but it's kind of a pattern that people who are familiar with charts and markets understand that that's something to look for. And actually in that complete guide to the futures market, kind of one of the things I talk about is how those failed signals are probably better than the classic interpretation of signals. So I totally understood what he was doing. So he got enormously bullish, and he puts in an order which is really too large relative to the capital he's managing. So he's a buy whatever it is, 500 contracts, whatever the number was. And from across the pit, one of the brokers flies over everybody else and says sold. Now the broker that did that was the broker for the merchant who held almost all the deliverable supply. So he just found himself on the opposite side of the party that really has the inside information and control. And everybody in the pit knew he was dead in the water. He knew he was dead in the water. Mm-hmm. Market went immediately limit down. It was several days of limit down before he was able to get out. By the time he gets out, even though he had a winning record, he's now down he's lost like 2/3 of his capital. And so he comes close to really quitting the business and kind of just decides at that point that why make this a thing of pain, and he got burned so badly that his risk management thereafter was just burned into his soul.
Yes.
But as an example, I mean, he became a legend, but he came inches away from just giving up, and for good reason. Stanley Druckermiller, another famous trader investor, he ran the Soros funds for quite a number of years when Soros was off in Eastern Europe. People don't know that, but he was the one who was really managing that quantum fund. But he also ran his own fund for like 30 years and had something close to a 30% average return over that period. Again, everybody acknowledges he's just one of the great all-time greats. But early on, he was capital squeezed. He started a fund. This fund he started, he didn't have enough money. He was making money because he was advising a client. That client had something unrelated to his trading, but had a loss elsewhere, and they had to cancel his consulting arrangement, and that was most of his income. And his overhead on the fund was just larger than he didn't have enough, that much money under management. It was largely in control. So he basically takes almost all his money, and he thought that this is back in the early 80s, and he kind of felt very strong that, and this is when, for people who don't know, this is when we had like bonds go to 13%, 14%. We had T-bills hit like a short-term high of 20%, and Eurodollars is just like another kind of similar to T-bills. So he just thought that we were near a peak in rates, and he wanted to be bullish the interest rate markets. So he takes a large position going long Eurodollars, and basically he just runs out of, he has to stop the position out. And he got stopped out literally, I don't know, just points away from a low, a low in interest rate instruments or high in interest rates that not only have we never seen, we've gone the whole direction for 30 years and plus 35 years the other way, but we probably won't see it for 100 years. Who knows? And so he has a trade which is really a sensible, a great trade, but because he doesn't have enough capital, he almost goes out of business. And so there are a lot of, that's interesting. That was a surprise with how many people almost never came to be. And just a small change in fate, and we never would have known who they were.
And the fact that they didn't give up, that is just a testament to their perseverance.
Well, that's part of the success story. That's something like Michael Marks in the first chapter of Market Wizards, where he failed repeatedly and wiped out his own account. Even lost his mother's money, and his mother was like lower middle class. So but what they just had this sort of confidence that they could succeed, and I think that is one of the elements. Is this extreme self-confidence and drive is one of the elements that is responsible for the ultimate success.
Yeah. Did you, I know, your focus is primarily on that technical aspect, but do you, looking at it from the perspective of I'm always fascinated around the emotional intelligence. Do you feel that you did notice that, even if you weren't digging deep for it? But do you feel that sense of their ability to stand neutral under fire is superior than the average person's?
Yeah, I think that's an element is this ability to not let your emotions influence trading. There's one exception in this book, but by and large, that's true almost in all these traders. Actually, Paul Tudor Jones in our interview, he's talking about one of his mentor, somebody he looked up to. It was a cotton trader, I think Eli Tullis. But he says one of the things he admired, he said he could be in his office and he knew he had just taken, and he had guests or whatever, he knew he had just taken a really large loss and you could never tell. You didn't know. And he admired that. And I think that's what good traders, I can think of traders where I've gone in and you can't tell if they have a really good day or a really bad day. And again, one case, I interviewed a trader and I knew he had a really good day, but he was just kind of like, you wouldn't know. It was like, nothing. And I'm sure if I went there on a day we had a really bad day, it would have been the same thing. So it's the separation of emotion from trading. There's a Hollywood image of trading, which is this high testosterone emotional thing, and it's that's because it makes good visuals. Yes. And real trading would be like an Andy Warhol movie. It would be like, and I say that for people who don't know, and not that I've ever seen it, but I know that I think Warhol did an 8-hour movie of just the front of the Empire State Building,
Right, exactly.
So that's what real trading is like. It's sort of the most boring thing you've ever seen if somebody made a movie about real trading.
And that's why all these poor traders don't ever get to see that. And they probably in the beginning feel like, what am I doing wrong? Because I don't have, all the fancy bells and whistles going off. I'm sure that, what's the word for it? There's this consistency that's required of you. Yeah. And consistency, look, not everybody's built for that. Not everybody's built for consistent, disciplined habits, managing risk. And that's, to the new traders listening, just ask yourself, do you see consistency, ability to be disciplined in your personal life? If you don't, how do you think you're going to be able to carry it over here?
Yeah. Yeah. Is that something you saw in the other traders, as in a lot of the traders, I guess I should say, is their lives in general? Are they consistent and disciplined in their lives too? Or did they or were they able to compartmentalize trading?
Yeah, I couldn't answer that question because I don't know them well enough. Typically the interview is during the course of a day. Occasionally, you might roll over to the second day, but I don't really. It's not like I spend, a couple of weeks with them and get a feel for how they live their life. I don't see that part of it.
Maybe that's the next Market Wizards.
Yeah, I think that's a good idea.
2 weeks with each trader.
And see what their secret sauce is in between their trading. What do you feel, Jack, you've learned for yourself that's perhaps different just in how you trade after interviewing these incredible people and or just living through the market that we've had in this last year too?
Well, for me, basically, the big thing, of course, the big thing was when I started trading, I didn't understand risk management. I didn't understand that was really the key. And through doing the interviews, I think I've reinforced it. There's also a concept that came up in a number of interviews, but the first interview where it came up was Bruce Kovner, who was talking about, he was starting to trade much larger and basically talked about risk. He said, the way I manage is I always decide where I'm going to get out before I get in. And that one sentence kind of summarizes what is for me kind of maybe the single best description of when I trade. What I do is like I'll always enter a stop, and I follow that. I rigorously follow that. I always enter a stop when I enter the order, so I kind of define what I could lose. And for me, that's very important because not only for risk management, but it takes the emotion out of it. I don't have to kind of agonize. Do I stay with it? Do I get it? Go? Should I give it more room? I make the decision in the beginning. So that's kind of the most important single line for me that I've ever had in any of the interviews. And it is integral to the way I trade. So there's that big influence. And then there are traders who mention things which I actually end up thinking about and ends up influencing. So like Marty Schwartz said at one point, if you're ever really worried about a position and the market lets you off the hook easily, don't get out. And I can remember, some years ago, this was a number of years ago, but at the time I might trade with the trend or against the trend. I'm kind of not one or the other. But if I'm trading against the trend, like the idea is I'll put a position on in a zone where I think the market will fail, and I'll have a stop somewhere beyond it. So in this particular case, I was kind of anticipating we'll get a relative peak in equities, and I picked an area to sell. I was about 80% positioned, and one day, Friday, we get an unemployment report, and the report couldn't have been more negative for the stock market. And the market sells off, and I think, oh, great, I just kind of thought, oh, this trade's going to work out really well because I just positioned short, and then by the end of the day, it rallies and it ends up for the day, and it was a Friday, so I kind of think I'm dead in the water. But on the other hand, I kind of remember what Marty said, and so Sunday evening comes, and the market, I was expecting it probably would gap higher. The market opens up lower, and it doesn't trade and it doesn't trade higher. And I kind of knew, I remembered Marty's line. I said, so I shouldn't get out, and I didn't. But during the day, I figured I don't want to tempt the fates. I maybe got out of 10 or 15% of the position, but I held most of it, and the trade worked out fine. But had I not interviewed Schwartz and had that thought in mind, I would have said, oh, thank God letting me out, and I would have covered the position. Yes. But it's particularly that, and there was another case where a trader talked about the correlation in markets. And the point was that what's important about correlation in markets is not when markets are correlating. What's important is when markets that correlate stop correlating. And so I had that thought in mind. There was a point a couple of years ago, or a year and a half, I can't remember exactly when, but when gold had made an initial peak and then went down and then rallied back to the same high. And during that whole course, gold and interest rates are very, very correlated in inverse sense. So interest rates going up, gold goes down. Or in other words, when T-notes are going up, gold is going up. They're both. And it just like the markets, they were completely in tandem. Then we had the period where gold made a high, and T-notes had just a really large up move. Gold went down and back up to the old high, and so it was back where it was. At the meantime, rates had come down a lot. So I was kind of thinking of this observation, and so it happened, partially luck, but it was really because I was thinking of that, and I basically bought puts what ended up being kind of the high day or next to the high day. Wow. And it was not because I was particularly brilliant. It was just, I think, well, this is a perfect example of a breakdown of correlation. The market's back to an old high. Probably buying puts is an asymmetric trade at this point. But again, I wouldn't have thought of that trade had it not been the interview. So there's, so I, like anybody, hopefully reading the books, will get certain ideas that end up being useful in their own trading.
Yeah, jewels. They're jewels on the path. These beautiful jewels that and even the way they embedded themselves into you, that you just were able to pull them up in that moment where you were like, wait a minute, this was spoken to. And that you have that in your file cabinet in your head is pretty magical.
Well, I kind of remember, because basically I'm distilling the best of what I get from these traders, and I sort of things like that I'll remember because they're very specific. And also they're not, the two examples I gave you are kind of, not the typical, everybody knows risk management and all that, although hopefully through the stories in the book, that theme comes across a little more memorably. But things like if you're panicked about a position and the market lets you off the hook easily, that's not the type of advice you get anywhere else. So it sticks in your mind because some of these things are unusual, or the idea that what's important about correlation is not the correlation, but the breakdown of the correlation. Again, it's not the typical thing that you hear or know.
Yeah.
So it sticks in your mind.
Yeah, for sure. And there's so I love the fact that each of them, it speaks probably specifically to their strengths and to their pattern, that which they're paying such close attention to. And because they're so varied, you're getting these facets of perspective that are all so unique.
Yeah, I mean, they generally speaking, almost every trader uses a different methodology, so you do get a range of ideas.
Yeah, it's awesome. Anything else that I didn't ask you that I should have, Jack, for those traders?
Yeah.
You're like, Kim, you missed the most important question. Nothing like that comes to mind.
When I do an interview, basically, I don't have any preconceived ideas that I want to talk about. It's just whatever comes up.
Okay. Anything that I've forgotten, Lucas, you think?
I just want to ask Jack, what is your passion? Because you have all these different careers, basically. It seems like what are you most passionate about?
Well, career-wise, like you say, I've done a number of different things, but the author part or writing a book that kind of at the end, I at the final draft, I read it and say, yeah, that's okay, that's pretty good. And I feel happy about it, and particularly if it resonates with a lot of people. So that sense of satisfaction is probably better than anything else I've done career-wise. So I would say that's first and foremost. Just outside of that, just from a living standpoint, I guess being physically active has kind of been the most important. That's always been the primary thing. From going all the way back to my freshman year in college, where and I was pretty out of shape, and I remember for the gym course they had us run 12 minutes, just how far you could run, and I was just amazed. I was shocked that I couldn't keep running for 12 minutes. And I was so that sort of was a wake up call, and I started becoming much more serious about getting physically in shape. But it ended up being sort of in my life. That was always, no matter how busy I was, I always made time, to go running or some other physical sport. And so whether it's running, hiking, cross country skiing, kayaking, so my big hobby has always been some sort. They're always solo activities. They're not. I've never been a team sport guy.
Wow. And am I correct that you said that right behind you, that beautiful imagery is one of the hikes?
So right now I'm in Winter Park, Colorado, and sort of right out my door, there's probably 100 miles of trails that I can access just right outside my door.
It's beautiful. Beautiful.
Well, I actually can't do all 100 because it's too far, but
but you could. You have lots of choice.
Trails. When I say 100, I mean it's multiple trails all over.
Makes total sense. Jack, you're an amazing human being. You changed my life with your book, Market Wizards. I love all your books. I really loved Market Sense and Nonsense because I just feel like you opened up my eyes to things that I didn't even understand before. But just thank you for everything you've brought forth and for your generosity of coming on here today.
Sure, I appreciate it, Kim. Nice to see you again.
This has been the Wall Street Coach Podcast with Kim Ann Curtin. You can find out more about her and her team online at thewallstreetcoach.com. If you've enjoyed this podcast, please consider leaving a 5-star review on iTunes. Thank you for listening.